Good afternoon, fellow traders. Thank you for joining today's webinar about the basics of technical indicators. Sorry for this small delay. I was just finalizing the technical setup from my side. And while we let the last people connect here, let me just quickly go through the risk disclaimer and then we can proceed. Contents of this material are provided by third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and BlueSky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, thanks for joining again to this webinar today. We're dealing with a new topic, which is basics of technical indicators. I will keep it short and sweet, but directly to the point. We'll discuss today what are technical indicators. Is a technical indicator a trading strategy? We'll also discuss different types of indicators, how many indicators you should or can use at a time. And of course, at the very end, you can ask your questions. So please be so kind, write them down during the webinar, and at the very end, when it's the right time, just ask away, and I will try to answer as many of them as possible. Okay. So, just a quick introduction. I'm one of the senior traders here in BlueSky Forex. We are an education, research, and trading group, and we do provide 24-hour trade support and analysis just to help all the retail traders to make better trading decisions and be profitable on the long run. BlueSky Forex is presenting this webinar on behalf of Hot Forex in order to educate and help you become highly profitable currency traders. So, first and foremost, what are technical indicators? That is the very main and very first question when you think of technical indicators. What are they? They are mathematical calculations based on the price, volume, or open interest of a security or a contract or any FX asset, essentially. Okay? And these technical indicators, they do manifest themselves in a graphical way as well that you can easily read. Okay? So that is the benefit of technical indicators, that you don't really have to read in a text form any data points in order to make your own conclusions. Of course, you can do that as well in terms of support resistance levels, in example, where different websites provide you with a certain numerical values where the support resistances lie. In this case, of course, you will be reading out the technical aspects of that technical indicator. But most of the technical indicators, they do provide a graphical, visually analyzable tool as well. Okay. Some of them, they are added onto the actual price chart. Some of them are added below the price chart or above onto the side. It doesn't really matter, but they are just differentiated from the price display itself. Now, by analyzing the historical data, the technical traders and analysts, they do use these indicators to help them predict the future price movements. Few of the very commonly used technical indicators include the RSI, the Relative Strength Index, the Stochastics, MACD, and Bollinger Bands. you will find a lot of different strategies that people have created, mainly based on technical indicators. You will find that these strategies use these four indicators quite often. There are, of course, a lot of other indicators that are widely used as well, but these you will find extremely commonly used. Okay. So the technical indicators, they're essentially a tool that will allow you to technically analyze the price movements. They will help you with this. They will also help you measure and interpret the market behavior. Okay, the market conditions, they will help you determine the market conditions that you are currently observing. And the technical indicators, they also, some of them help you measure any number of different factors, including shares traded, ratio of stocks, rising, declining ones, and of course making the ones making new high and low. And this is just simply, talking about the stocks themselves. Okay. Now, here on the very top picture, you see a Bollinger Band drawn onto the price chart, and of course the RSI beneath it. So just to include an image to show you what I meant by when the indicator is drawn onto the chart or in beneath it. So the RSI and stochastics are usually drawn beneath the chart, while the Bollinger Bands and the moving averages, for example, they are drawn on top of the price chart itself. Okay. So indicators like moving averages and Bollinger Bands, as mentioned before, they are mathematical formula-based calculations or tools that you can use to just analyze the past price, and they will help you predict what the price might do in the future. Just to help you predict the upcoming trends, any price patterns, even the actual indicators themselves can form patterns visually that you can determine. And these help you and predict the future price movements. Okay, we do have a webinar where we will discuss different formations that the Bollinger Bands provide you and how you can utilize those Bollinger Bands formations to make better trading decisions. Okay, so definitely attend that webinar as well. The headline should be the advanced core strategies. Okay. So the fundamental traders, as we also speak about usually on most of the webinars we do, that fundamental traders, they analyze economic or annual reports and other fundamental events and news that they can read about. Technical traders, on the other hand, they rely mainly on indicators, on technical indicators, to help them interpret the market. Okay, so the fundamental and the technical traders, I mean, anyways, they do what they do in order to help them identify the market conditions and identify the trading opportunities. It's not only a case for technical traders. Okay, so the fundamental traders analyze those news, events, and other fundamental data to also identify trading opportunities and determine the market conditions. So a question you might then have is an indicator a trading strategy? And when I started trading, I was really drawn to using a lot of different indicators, just testing them out, testing different combinations of them. And I believed that simply using technical indicators, setting certain conditions between each other and identifying certain formations in the indicator, this is enough to consider it a strategy, okay? However, over the years, I have learned to understand that this is really not true. An indicator on its own, or even a combination of indicators, is not really a trading strategy, okay? If you think that just blindly following or developing certain rules between technical indicators and blindly following them is a good enough strategy for you to be profitable longer term, uh, I'm sorry to break it down, but it's not the case. What you have to understand is that in order to be successful longer term, you will also need to be aware of your own trading habits, the way you manage your money, the way you manage your risk, what sessions you're trading in, what are the FX pairs that you tend to trade, what are the different characteristics of those pairs, what are the different characteristics of the different sessions you're trading in, your emotion control, and all that included forms a trading strategy. So put everything related to trading into one boat, and that becomes a trading strategy. Okay, an indicator on its own is not a trading strategy. Please keep that in mind. You cannot really blindly follow a set of rules with the indicators and hope to be successful longer term. Okay, you have to be able to some degree, read and understand the news, the economic events. You have to be up to date. When are the news releases? You have to be able to draw your own support resistance levels on the chart and all those small bits and pieces. Okay. So strategy, you can put it bluntly that it is a trader's rule book. Of course, it's a trader's rule book when it comes to all the things that I discussed before. Money management, risk management, also the indicators and the conditions between them. Okay. And putting or following that rule book that relates to the conditions in the indicators, money management, etc., that helps you make educated guesses about the future market activity. Okay. And when it comes to indicators, there are definitely a lot of different types of indicators out there that I will get to very shortly as well. Now, and also considering the types of indicators, I want to mention that if you are composing a strategy and you want to include different indicators to help you analyze the market conditions and the price movements, then it's wise to use different types of indicators in one strategy. Okay. For example, include one trend indicator and one volatility indicator. For example, this is just a very blunt example just to bring out here. It's not really wise to use the same type of indicator, multiple same type of indicator in one single strategy, because essentially what you would be doing, you are reading the same data, just a little bit in a different visual way, or the formula is just a little bit different, but essentially you're still looking at the same thing. And the data that you read from all those indicators that are with the same type, the information or the data ultimately becomes redundant, and it can draw your attention from the actual price movement itself, because you're really knee deep into analyzing the exact movements or indications of that certain correlation of indicators that you have set on the chart. And if you are counting essentially the same information in a bit little different forms, That is a statistical term referred to as multicollinearity. Okay, so please try to avoid that. Always use indicators in a different type. Okay, so just to conclude this slide, an indicator on its own or even a set of indicators is not really a trading strategy. A trader's rule book that consists of money management, emotion control, risk management, of course, set of indicators and rules based on those, session you're trading in, and so on. All those bits and pieces put together is a trading strategy. Okay, so please keep that in mind. Now let's take a look at different types of indicators. Okay, so if you are developing a strategy, then obviously you will need to find, if you want to incorporate a technical indicator into it, you will need to find uh, a certain indicator that really suits your trading style and need. Okay, so if you are, for example, a longer term trader and you are seeking for long-term moves with larger profits, you might be more interested in a trend following a strategy, thus using a trend indicator like a moving average or a MACD. But if you are a scalper and you are aiming for these frequent smaller gains with smaller price moves, then you might be looking out for volatility-based indicators like Bollinger Bands. Okay, and below you have the image that shows different types of indicators and just brings you a few examples here as well. So for a trend, we have moving average, MACD, and parabolic SAR. Then for momentum, we have a stochastics, we have the CCI, we have the relative strength index, we have Bollinger Bands as the volatility um, type indicator, also the average true range, the ATR, standard deviation, which is already part of Bollinger Bands. And also then you have the volume indicators that you have below there as well. Okay, so you see different types of indicators. The one whose calculations are based on trends, movements, momentum, volatility, and volume. There are also a different way to categorize the indicators, which I will show in a moment. And as I mentioned before, indicators on its own do not make a trading strategy or trading signal. Okay, so you need to develop your own strategy. You need to find your own indicators that really suit your trading style. And again, don't use multiple same type indicators in a single strategy. Now, after you have identified certain indicators that you want to use, you have determined a set of rules or conditions between those indicators that you want to follow. And of course, you incorporate the parameters of your risk management, how you manage your money, and of course, the session you're trading in, etc. If you set all those conditions in place, then those conditions will allow you to backtest the strategy with the historical price data and see how viable those conditions of your strategy would have been in the past. Okay, you can do this visually. You can code an expert advisor to help you backtest automatically a set of conditions inside the MT4, although there are certain limits in place, because quite often if you start automatically backtesting a strategy, you can't really I think it even applies if you manually start or visually start backtesting a strategy, or so to say paper trading, that you can't really apply emotion control to it, okay? Because you would be testing without any emotion because you're not really trading, all right? And you could not really have determined what would your emotions have been during that certain time in the past. So you're just leaving out a few components when you are backtesting. But otherwise, it is really sufficient to backtest a strategy before actually going to start testing it live, aka forward testing a strategy. I believe the backtesting is quite an extensive topic, and it might even be enough for a separate webinar one day, because you do need to consider a lot of different things when you are backtesting, the set of data that you are using for the backtest, etc., and how you're going to conduct it. Okay, and of course how to analyze the data later on. That's also a different topic on its own. So a backtesting strategy can be quite a tedious process. It can be extremely time consuming because a lot of the times you will realize that the set of conditions that you have determined inside a strategy didn't really work out in the past, even though if you, before the backtest, you have demo traded them for a month and then they have worked out really well. It doesn't matter that in the past those conditions in the set strategy would have worked out that well. Okay, and you will start redefining the strategy, and that can take extreme amounts of time. So if you don't have the time, then I would say just forward test the strategy based on the conditions that you have created between the indicators and the other parameters. Okay. And one really important thing to mention here as well, that whenever you backtest a strategy and it is successful for that period of time you use for backtesting, it does not necessarily mean that it will be successful in the future. So please definitely keep that in mind. It's really important. The past performance is not indicative of future results. That's the bottom line. Okay. Now, the other way how you can categorize the indicators is a lagging indicator and a leading indicator. Okay. So what is a lagging indicator? A lagging indicator gives a signal, a trading signal, after the trend has already formed to some degree. Okay. So after the price starts moving in a certain directions or starts behaving in a certain way, the lagging indicator will take a bit of time and then tell you that pay attention to what the price is doing at the moment, because you might be missing out from a good trading opportunity. Okay. One of the few of the examples are the RSI and stochastics. And the way the RSI lags behind the price a bit is that the RSI, when the new higher peak is forming, for example, the RSI takes a bit of time to actually get to the overbought status on its own scale. Okay. The RSI is actually a bit interesting because you can also, in a way, consider it as a leading indicator. Okay. So the RSI is not really the best example of a lagging indicator because in a way it's also a leading indicator, and I will explain why. We also have a webinar about divergences between indicators, and the way the RSI and the price divergence works, that Let's say the price is moving in a certain direction. It's forming newer highs, okay? But at some point, you see that the RSI is not really forming new highs anymore, but it's forming lower highs. So the RSI is moving in the other direction, while the price is still moving in the same direction where it was moving before. Okay, so you see the divergence between the price and the RSI, and this formation is actually a leading indicator because it is hinting about the future price reversal. Okay. So the RSI, in a way, is a lagging and a leading indicator at the same time. Okay. Then you have the leading indicators, which are the moving averages and the Bollinger Bands. Actually, I think I need to apologize because it seems it's actually way around. Right, there has been a small mistake in the examples. They should be the way around. So that is the reason why I brought up this RSI being the both at the same time. Anyways, we have the stochastics and the RSI categorized as a leading indicator officially, the RSI actually being both, as I mentioned before. The lagging indicators are moving averages, Bollinger Bands. So sorry for this small deception for a moment. Anyways, the leading indicator, as you can see on the image below, is that they already start indicating the future price movement. So if the price takes its time to actually reverse, a leading indicator is already hinting about the upcoming reversal. Okay. So the purple line is the price and the green line is this leading indicator. Okay, so just a visual replication as well, what it means. Okay, so our next question is how many indicators should be used at a single time or a single chart or in a single strategy? Well, just to let you know that there are so many different indicators out there, tens of thousands of indicators out there to choose from. A lot of them, they are really similar. They have similar formulas and they are calculated in a similar way as well, but they might manifest themselves differently visually or differently on the chart. So you just have to make your own picks. You can use the most popular ones, or you can do your own research and find out which ones you like visually the most or which ones work best for you. So it's really, really up to you which ones you would like to incorporate into your trading. In terms of your trading equipment setup, as mentioned in the previous webinars as well, it's not really wise to use a smartphone or a tablet or even a small laptop for trading. If you want to be a serious trader, you should have at least 2 monitors, and each and every monitor should not have more than 4 charts. This should give you enough space to execute your trading activities and enough space for you to, in a proper scale, analyze your charts and the price movements. Okay, so at least 2 charts, at least 2 monitors with maximum of 4 charts open on each and every monitor. Okay, try to keep it simple, try to keep it clean. I will show you also a small picture of one workspace that I found online. And you can also write in the comments or question section later on what you think about that setup. Okay. Something to keep in mind that throughout your testing, you might, use different types of indicators, different combinations between them, and you might eventually, clutter up your workspace. It's fine if you're just, finding the indicator that you want to use or creating conditions between different indicators and trying to find the one that really suits you the best. And if you start setting up that strategy or a bunch of test out indicators to a demo trading environment, you might forget some indicators onto your chart that you don't really use. Okay, you still tend to use some other key indicators mostly. So if you notice an indicator that you're not really monitoring that much, or that means that you prefer using other indicators over that certain one. So it's best just to remove it from the chart, okay? Because that will take up space and you want to keep it as simple as possible. Don't clutter up your workspace again, okay? Especially if it is the same type of indicator, okay? So don't use same type of indicator on a single chart. It would make sense to use maximum maybe 2 or 3 indicators at the same time on the same chart. Bollinger Bands, for example, being one of the most useful and most it is the best indicator what we can think of actually. It provides you with these different formations visually that you can analyze on the price charts. And yeah, those different formations can really raise your trade accuracy. An RSI is another popular indicator that you can use, and that RSI shows you the status of the price, whether it is overbought or oversold. So the overbought status price might reverse shortly and start trending in the other direction. An oversold price does the same, right? So definitely, please keep in mind to keep your workspace organized. Don't clutter it. Keep it simple and clean. So on the left top side, you see a workspace that we found online. Already by analyzing those monitors, I mean, you see there's a lot of these. That's fine to a certain degree. If you are a professional trader, you need that workspace. You need to have multiple assets to analyze correlation, for example. Then you have to have a lot of monitors and a lot of different assets open. However, if you're analyzing all those assets separately to make separate trading decisions upon, then, keeping it a bit more simple than that is definitely recommended. Okay, maybe have up to 10 assets open at a time. That's more than enough. If you're starting, then 5 to 6 charts is completely fine. But on the image above, you can see how cluttered the workspace is. You see so many indicators on those charts that it makes it difficult to even see the price itself. Okay, a lot of Bollinger Bands with different settings, a lot of zigzags there. I see also moving averages there, and of course vertical and horizontal lines for support resistance levels, also different time zones, etc. So it's not necessary to have so many indicators on your chart. Just keep it more simple, okay? And what I like to say is the most important indicator to analyze is the price itself, okay? Well, the price itself is not an indicator per se, but you know what I mean. If you like analyzing the indicators on the price chart, it's fine, but the most important thing to observe and to analyze is the price, because all the indicators and the formulas are really derived from the price itself. All those calculations are based on certain degree of the price, okay? So you can simply trade based on the price movement. It's also possible, okay? No problem at all. You don't have to use any of those indicators. You can simply trade price action. And the above here is just an example of a clean chart. The only thing you see there are Bollinger Bands and an RSI. This way you will be able to easily analyze the price itself. You can see the price properly. You can see what it's doing. And the RSI at the very bottom is not really taking up too much workspace either. Okay? So this is way cleaner than the previous screens that you saw. It will provide you with a better environment to make your trading decisions and just analyze the price and see what it's doing. And again, you just need to determine what indicator is best for you, what type of indicator you would like to analyze based on your trading habits. So last but not least, we want to discuss about the currency trading dangers as well, because we want all the traders to trade as safe as possible. The first and foremost, please refrain from trusting bots or expert advisors or any robots that you come across that are advertised like, get rich with a few clicks here and there, or get rich with 10 days, earn millions, and so on. This is already a straightforward red flag, and you should avoid any of these robots that are advertised that way. Okay. If you want to try out a bot or a trading robot, please do so on a demo account for an extensive amount of time, for 4, 5, 6 months at least. If it was able to generate consistent profits on your trading account for that time without a large drawdown, then you can only consider setting it up for a live account, but then please do so with low lot sizes. Because most of these robots and bots, they are designed to generate losses on your trading account. So please be extremely careful. Now, sad but true, only 5% of all retail traders make money long term in FX. And the main reason or the main driver behind it is our own human psychology. It is quite difficult to manage our own emotions when it comes to trading. If you are on a winning streak, then there is a certain chemical released in the brain. One of them is adrenaline. This makes you feel invincible, that you cannot really lose ever, and you want to just make more profits and win more. Okay, that's a completely normal reaction. However, when trading and you are on a winning streak, that creates a problem, because you will start over trading, and eventually you stop analyzing the price properly and you start making mistakes, thus losing all your earned profits, or just completely emptying your account, or just earning some losses instead. And on the other side, if you are on a losing streak, then a different type of chemical is released in your brain. What happens is amygdala hijack is the term that happens in your brain, and you will start revenge trading. Okay, after you lose some money, you want to start earning that money back, and you're relatively angry, or you are already stressed. And revenge trading will eventually result in you again making stupid mistakes and generating even more losses, or completely emptying your account. So a lot of traders, they approach trading with a very simple mindset, like they have been advertised. You will see a lot of advertisements out there, maybe not so much right now, but in the past it was worse. That you can become rich with a push of a button, or work home, become rich, etc. Okay, and then they provide you with all these glamorous pictures of people, drinking champagne on yachts and all that funny stuff. golden Ferraris and Lamborghinis and whatnot. And I mean, to me, it's funny and sad at the same time because all these retail traders, I mean, upcoming retail traders, they are lured into trading and they are deceived that trading is easy. We all know by this time that trading really isn't easy because it's relatively difficult to manage yourself and your emotions and follow the rules of the strategy that you will ultimately develop. Okay? You have to be extremely strict. You have to be able to handle your emotions and analyze your trading habits, realize what they are, and so on. So it's really not an easy task. If you want to become one of those 5% of traders who make money longer term in FX, then you have to be a strong person. I mean, that's no joke, right? You have to be a strong person. You have to have a strong mentality to learn from your own mistakes, to be persistent, because people who are emptying one or two accounts, which leads me to the next point, people who empty one or two accounts and then consider trading as a scam and are not persistent, uh, they are among those 95% who actually lose money longer term in FX. Okay, and it is sad but true. So, in order to be successful longer term, please take your time, keep a journal, analyze what you are doing on each trading session. After the session has ended, take maybe 15-20 minutes to do that. Pay attention to every small detail of your trading during that single session. Later on, after some time, you will be able to draw your conclusions, determine what habits you have developed over the time, if those habits are really positively affecting your trading results or negatively affecting them. And yeah, ultimately, you can just try to avoid the negative habits and empower the positive habits. And blowing up few accounts in the beginning is really a part of the journey. Okay, so it's not a bad thing because blowing up few accounts, it really shows you that you need to change something. And in order to change something, you need to keep a journal. Okay, and you need to be able to analyze yourself and determine what trading habits do you have, what trading habits you have developed over the time. So don't take that as a really bad thing. A lot of people, they blow up an account and they walk away and they never return, and that is the reason why a lot of people are not successful. Also, last but not least, only 5%, maybe even less, of the signal services and signal rooms are legitimate. So please be extremely careful before engaging in one of those or putting any of your hard-earned money into them. If you decide to try out one of them, please do so on a demo account again, and definitely ask for a performance record and an audit trail. And if possible, any other current users of the same signal service or signal room, check what experience they have had with that provider, if they have been able to consistently grow their account capital with their help. And if so, then only consider setting it up on a live account and of course use low lot sizes. Okay, you need to trade as safe as possible because then you will survive the longest. You will be able to gain most experience, and experience is something that will eventually lead you to success. Okay. So this is it for today's webinar. I hope it was straightforward, and I hope it was as simple as it could get. Just a few basic things about technical indicators, how you can observe them, and what to pick. So I'll take questions now. Let me just open up the questions section, and you can ask away. Adesagan is asking, can we get a recorded version of this session? All these webinars, they are recorded and they will be uploaded in the past webinars section on the Hot Forex website. You can find this when you log in and go to the, it should be education section at first. You will see a list of upcoming webinars, and there you have a link that will lead you to the past webinars. And there, of course, you have the list of all the past webinar recordings, and you can find it there after some time. Akim is asking, what parameters for Bollinger Bands are best? Okay. The standard parameters for Bollinger Bands are usually a period of 20 and a deviation of number 2. Okay. However, depending on the volatility of the price, if the price movements are extremely volatile, then you can also raise the period of the Bollinger Bands to 25 and also raise the deviation of the Bollinger Bands to 2.5. So I personally use anything ranging from 20 and 2 to 25 and 2.5. Lawrence is asking, does Hot Forex give any successful trading strategies for trading? I know that Hot Forex team on their own also have a lot of different market analysis webinars. They also teach various different aspects of trading, obviously. We here in BlueSky Forex, however, we also do provide a few trading strategies based on our BSB core, and these formations rely heavily on Bollinger Bands. Okay. So if you can attend one of our webinars, which is called Advanced Trading Strategies or Advanced Strategies Explained, then you will get to know these 4 formations that we teach here on our webinar series as well. There are a few other webinars where we talk about some other approaches to trading as well, so it's really up to you. I'm sure you can find these in the past webinar section too. Adesigan is asking, is there a webinar or training to understanding the use of all these different indicators? Sure, there are. For some indicators, we have material to show how to use them. Just a few really simplistic approaches how to use those certain indicators as well. For the Bollinger Bands, we have a bit more advanced formations and strategies provided. For the RSI and some others, we have, we're explain what the indicator is, and we provide also a very simplistic approach how to use it. So I really highly recommend to go through the past webinars section in the Hot Forex website. I'm 100% sure you will find a lot of material to study from. Last call for questions, everybody. Okay, as there is no further questions coming in, then thank you very much for joining today's webinar. It has been my pleasure to host this one for you. As always, please trade safe and have an excellent rest of the day. Take care, everyone.